Welcome back to the Dividend Diplomats YouTube channel. You're rocking right now with your boy Bert, the Hurt, the one and only. And you got Lanny, the DD guys. And here we are. I know if you're watching this, it's on Thursday, but we're recording it here on Tuesday. So let's see. Did the Fed increase that interest rate by 75 basis points?
Oh, man, this is going to be a great week. We're going to know a lot by the time this video gets released, but it doesn't matter because when we talk about these banks, they are well positioned to already crush the market and see what's going to happen. I think that's what's going to be fascinating. Oh, wait a second, Lanny. You know what I forgot to ask everybody to do before I started talking? Smash that subscribe button. Give this video a thumbs up, everybody. Up, up, and away. We are trying to cruise towards 15,000 subscribers. Thank you, everyone, for all of the support. Lanny, talk to us. Let's talk some banks.
All right, guys, we're talking about bank stocks. In case you haven't heard it from Bert right now, we are going to be talking about three big banks today on this video. Three of the top five largest here in the United States. One just also increased their dividend 20% here on Tuesday, July 26th. Wells Fargo calling you out right now. Better believe it. But we really wanted to put the banks in the ring as the Fed is about to increase that interest rate, just to see how the bank stocks are going to react. Because frankly, these three banks are all screaming undervaluation right now. These are three banks, three dividend stocks to buy right now based on the metrics of the Dividend Diplomat Stock Screener. And Bert, what are those three metrics, baby?
We got that. Number one, that holographic Charizard. Number two, that holographic Venusaur. Number three, that holographic Blastoise. Isn't that it there, Lanny? The first edition base set.
That almost can be held in your brokerage.
Yeah, that's right. Or in that eBay vault. Anyway, the three metrics of our stock screener are price to earnings ratio less than the S&P 500, payout ratio less than 60%, everybody. Number three, the history of increasing that dividend, where we look at how long a company has increased the dividend and what their 5-year average dividend growth rate is. And Lanny, for a good measure, we put on the leather jacket and we put the pipe in, we start getting our big smoker's jacket going, and we talk about the dividend yield as we cover that final bonus metric.
I have no idea how much wine Bert's been drinking tonight, guys, but we are here. It's about to dive into these three stock metrics. Again, filming on July 26th. Stock market has shown a lot of green days lately. Actually showed red today. S&P 500 trading just over 3,900 right now. Last 5 days about flat, but over the last month slightly up. The predictions again are 75 basis point increase in the market. The S&P 500's average PE ratio right now across the whole market is about 20 still. So we're going to quickly dive into three big stocks. We're going to be talking JP Morgan. Yes, Jamie Dimon calling you out again. Warren's used to be favorite, now not so favorite. Wells Fargo, WFC, and I had to give O to Bert on this one because I know Bert's owned this stock and has been adding a lot to his position.
It must feel like when Warren Buffett went from Wells Fargo to Citibank, that had to have been what it was like when Hogan left WWE to go WCW, right? It had to be the same feeling.
It is the same thing, I think.
Yeah, that's exactly what it is. So we're going to talk about these three banks as you talked about, Lanny. And
Citigroup is the third bank.
Oh, do we not? My bad. I was supposed to do the bigger hill. That's right. Citi.
That's right.
Yeah, we've been buying it this year, building up that position. Citibank will be number three. But to your point, Lanny, the market's had an interesting week. We're expecting 75 basis points. Earnings season's been off to a bang. Some companies are great, some bad. We've seen telecom stocks get slammed. Others might be signs of some inflation easing a little bit for some of these companies. That's one of the other big pieces that's coming along here. Jamie Dimon's given his piece about the economy, talking about how his reserves are going up for a potential recession. You've seen that through a lot of other banks. So it'll be interesting to see what this Fed's saying. And that's why focusing on these three banks that are at the heart of everything right now is going to be so critical.
There you guys go. So let's dive into JP Morgan Chase. Ticker symbol is JPM. We're going to quickly again go through the metrics here. You guys know Chase, biggest bank pretty much in the world, over trillions of assets held in their balance sheet. Down actually this year, over about 30% this year, guys. So, if you're looking for a time to buy JPM, Chase stock, now is not a bad time just by pure down pressure on the stock price.
But not just that. When we look at these metrics here, that's going to also be a good reason to hold that thought there, Landon. Because I think when we start peeling back these metrics for JP Morgan, it's going to look even better. Should we kick it off with that first metric here, Landy? That price earnings ratio? I can take care of this one.
Yeah, go ahead, Bert.
Price 113.42, forward earnings 11.19, PE ratio 10.14.
Guys, they're pretty low PE ratio for JP Morgan, the diamond itself, diamond hands over here. Looking at that second metric, the dividend payout ratio pays $1 per share per quarter, $4 per year. Taking that $4 over the expected earnings of $11, that dividend payout ratio is 35.75%. Absolutely safe and absolutely has plenty of room to continue to grow that dividend. What's that third metric?
5-year dividend growth rate, 16.15%. Increase that dividend for 11 plus years. They've increased it every year that they've been allowed to after the financial crisis, when all the banks had to kind of stop with their dividend payments. So, I mean, that Jamie Dimon's not messing around here with the metrics. And kind of popped out to me, Lanny. I'm just going to be honest with you. What's that yield that we're talking about here for JP Morgan?
Guys, this yield is now over 2 times the S&P 500. That dividend yield is 3.53%. So very, very nice, dividend yield to go with that double-digit dividend growth rate for the largest bank here.
Yeah, so when you look at all the metrics here in summary, we'll just put the chart up since we just ran through them a second ago. So I'm saying this might be a great time if you're looking for a big bank, one of the best out there, JP Morgan. The metrics are looking pretty solid here, Lanny. The question is, though, how does this stack up against 2 of the other titans of the banking sector?
Well, let's dive into Wells Fargo. Again, we're talking Wells Fargo. They just increased their dividend today, July 26, from 25 cents to 30 cents, going up a nice 5 cents per share per quarter, or 20% dividend increase. But now they're still trading at $42.90, down 15% this year so far. That dividend increase to 30 cents is still less than where they were pre-pandemic, which was 51 cents. This is, I think, and somebody can correct me in the comments, this is the 3rd dividend increase since they destroyed that dividend.
Destroyed is the way to say it. Wells Fargo, it's not a secret that they went through some tough times there. The dividend suffered. I mean, that's why Buffett's no longer there. He was always in it, was always billed as one of the healthier financial institutions. A few scandals later, a few dividend destructions, I think is probably the right way to say it. So, all right, though, they're rebuilding it. 20% dividend increase is solid. It's a great way to start that rebuilding process and bring you back.
Yep, it's fantastic, guys. So we're going to be looking at the stock screener metrics now on Wells Fargo, the out of favor, out of flavor. Don't give me that strawberry because they're not chocolate or vanilla ice cream right here, guys. Price to earnings ratio, analysts are expecting $4.01. So at a stock price of $42.90, that's a 10.7 P ratio, pretty similar and in line with JP Morgan.
Now that new annual dividend's $1.20. Divide that by the earnings, that's a 30% payout ratio. There, again, less, but in line with JP Morgan. There's still plenty of room to keep growing that dividend.
Still plenty of room. So what else, Burr? What else we got?
I mean,
here?
They don't really have a dividend history. I think we kind of covered that. So we don't need to really go into that, but let's look at the yield. Now, after that dividend increase, the yield's 2.8% for Wells Fargo. So trailing JP Morgan, but again, premium compared to the S&P 500.
They are trying to climb back, hence that dividend increase of 20% today, guys. So again, 10.7 PE, about a 30% payout ratio. No real history outside of this one dividend increase for, 20% because they destroyed their dividend. But an above average dividend yield at 2.8%, but not quite JP Morgan Chase.
Yeah,
but
they're performing better. They are performing better than JP Morgan, only down 15% this year compared to JP Morgan, who's down 30%. So there's that.
There
But
is that. Bring it
let's
in, Bert.
let's round this out with our third stock, Citigroup. I haven't been shy about the fact that we've been building a position for my wife with Citigroup. It hit its peak last month before the major news about Buffett jumping in, before some of the other news release. They had a strong earnings release. Price was in the 40s, the low 40s, jumped back up to $50 per share. But the question is, even after that hype landing, are they still undervalued? Let's run them through the stock screener to find out. Their current closing price is $51.40. Forward earnings per share is $7.20. That's a PE ratio of 7.14.
Wow. So, guys, the P ratio, the lowest of the trio here at 7.14. Now, the dividend, they pay about, I don't know, 51 cents per share per quarter, or $2.04. So the payout ratio is also the lowest out of the trio here at 28.33%.
And what's interesting, we'll just talk about the next metric here because it all kind of ties together, dividend growth rate. They haven't increased their dividend for several years since the pandemic started, but their 5-year dividend growth rate is 31%. So what you're seeing with Citigroup, that's different than a lot of the other institutions. They juiced up that dividend before the pandemic to a higher level, so they had a higher base of a dividend compared to a lot of the other major banks. Since the pandemic, though, they haven't increased. They've ran their test. They're comfortable where the dividends at in their capital plans. All great, though, because when you look at the yield, you can see why they're not exactly eager to start juicing that up again. Lanny, what is Citigroup's dividend yield?
So, guys, just remember, JP Morgan had over 3.5%. Wells Fargo was at 2.8%. Citigroup is just a smidge under 4%. So they're the highest yielding dividend bank stock out of the big bank stocks here to buy, out of the big three right here, 3.97%. Wow. Oof.
Down 18.54% today.
So, guys, there you have it. Really, everybody on this list, JP Morgan, Wells Fargo, and Citigroup stock have low price to earnings ratio. Citigroup obviously has the lowest at 7. Now, the dividend payout ratio, the lowest again goes to Citi.
Yeah.
The best dividend growth streak, though, is going to have to go to JP Morgan Chase at over 11 years, more consistency in growing that dividend. Dividend yield, though, goes back to Citi. And then, this is a toss-up. It sounds like Wells Fargo, though they're trying to make a comeback, probably is not the best out of the three yet.
No. I think what's interesting is then it brings it down to JP Morgan and Citi. And I feel like you have the tale of two completely different massive banks. JP Morgan, you could argue, is always historically one of the best run institutions, with Jamie Dimon leading the charge. I mean, it's not exactly a secret what he's done, what he means for the company, and how well of an oiled machine JP Morgan is. Citigroup, on the other hand, was historically not a great management company. They have a new CEO. They're turning it around. They're shedding down. They're slimming down, focusing on their core, but it's taking time to rebuild. That said, their metrics are showing much cheaper than JP Morgan, but when you take a step back, JP Morgan down 30%. It's an incredible time to consider JP Morgan. It feels like they haven't been around this level for a long time.
I could not agree more. So, guys, it looks like right now it's a consensus here that JP Morgan, being the biggest one, might be a great one if you don't own a bank. Citigroup, maybe not to say it's a speculative bank by any means, Citigroup, but they have probably more volatility, over on that side. You might not know what you're going to get with Citigroup. It's like Forrest Gump and chocolates. You just never know what you're going to get. But if you're looking to own a bank, JP Morgan.
Yeah. I mean, and similar with that was Wells Fargo, despite some of how their metrics are showing. Who knows where that bank's going to fall out after the shakedown with everything that's happening in the turnaround story. So I agree. JP Morgan's number one on this list. So everybody, let us know in that comment section below. What do you think about these three big banks? Do you agree with our rankings? Do you think JP Morgan comes out on top when you put these three banks in that triple threat? No. And you know what, Lanny? If the people haven't done so already, what the heck do they need to do?
You know, guys, let's make sure to give this video a nice thumbs up, smash that subscribe button, give some love to the diplomats and to the community here, because we are just going to keep pushing out content to help you stay informed, find undervalued dividend stocks to help you on that journey to financial freedom. That was Bertha, Hurt, and Lanny from the Dividend Diplomats. Over and out.